We've obviously seen some unprecedented moves in precious metals in the last few months. The main drivers will be, US interest rates, US 10-year Treasury yields, tariffs being announced by the US administration following the presidential election of Donald Trump, and extraordinary physical movements we've seen moving from London to New York since December, beginning of December and through to January, even to this day. So we've seen since December a number of US institutions, primarily, mainly banks, looking to load up on physical gold inventories in New York in COMEX vaults. Something we haven't seen since March 2020, April 2020, during the COVID pandemic, when a lot of the logistics providers were unable to move material from the Swiss refineries across the Atlantic into New York. And typically people want to deliver metal against short futures paper positions. In New York, typically only about 10% of short futures positions are delivered against with physical metal. This is now changing, with a number of houses and banks and market participants in December and January deciding, if tariffs are announced on gold and also silver to a certain extent, potentially platinum and palladium, along with other far-reaching tariffs, there could be a shortage of gold in the market in New York. So we've seen over 2,000 tons of gold move across the Atlantic, and I expect us to see more of this over the coming year. So typically, the London market is an OTC physical metals trading market on precious metal space. And New York is really a futures paper derivative driven market. And typically a bullion trader will be long physical inventory or physical metal on their account in London, from various mines selling gold to them from all over the world into LBMA vaults or, bank vaults, Brinks vaults, etc. And then it will typically sell equivalent futures to hedge that position in New York. So they basically are delta neutral, don't have a price risk, depending on, market moving higher or lower. What's been happening recently is, due to the extortionate amount of gold that's been moving from London to New York, 2,000 tons plus, in December, almost every single flight was booked across the Atlantic with all the shipping logistic providers. You couldn't even get metal on a flight because they were so booked up for the next 2-3 months. And also the issue is, participants have been taking gold out of a London physical market to move it to New York, but there are contract differentials for physical delivery. So in London, the OTC gold market typically is backed by a 400-ounce gold bar, or a brick, as you would normally see. Now, you have to take that 400-ounce bar, refine it at a Swiss refinery or any LBMA London Good Delivery approved refinery, and then you'll have to ship that across the Atlantic into New York, and you can only deliver 100-ounce CME Good Delivery bars, or they call it 4.9 purity kilobars. Obviously, there's only a certain amount of refinery capacity that can do this. There are some LBMA refineries around the world, like there's Metalor in Singapore, there's Valcambi in Switzerland, there's Argor Heraeus in Switzerland, and then there's refineries in the US, such as Asahi and Metalor as well. These refineries are now backed up by approximately 6 weeks, some of them even longer, and the refining rates obviously have gone through the roof. So there is a shortage of physical metal on the short term moving into New York, and a lot of these traders that are short futures on COMEX are trying to build up as much physical inventory as they possibly can before potential tariffs come in. Maybe they're announced they were supposed to be announced in 1st of February, then it could be March, could be April. No one really knows. Is it a threat of tariffs? Is it not tariffs? The likelihood is gold will probably not be tariffed because it's a monetary asset in America, and you would expect it not to attract tariffs. But in the current environment we're seeing with the Trump administration, everything's on the table. So it's actually sound risk management for traders and for market participants to load up on inventory in New York, and that's caused a real squeeze in London temporarily, whereby we've seen the forward curve that was traditionally a contango flip into a backwardation, and it's been, metal's been in short supply in London. So this divergence between the exchange for physical really occurred because typically traders in New York, they have short futures positions. In London, they're long physical. And the EFP, exchange for physical, enables you to manage your risk between those two strategies. Now, what happened was, let's say it was November, December, EFP might have been trading at, say, $10 an ounce. when people started to realize there could be a major shortage of gold in New York shifting from London to the US, and no one knew when tariffs would come, EFP started to blow out, as they say, or it went very well bid. And I think we got to $50, potentially $60 an ounce, really because there was just a short-term draw on liquidity for metal going into New York. And really what was happening was a lot of traders were realizing if they can draw metal down from London vaults, ship it across to the US and prepare pre-tariffs, they're in a very good position. If the market moves into a backwardation, they can actually start lending metal to other market participants and earning positive carry. And traditionally, you've been, getting in a contango market whereby the future price is higher than the spot price, and that hasn't been the case. So that's what's really driven the dislocation between the two markets in the EFP. So typically in the gold market that we've seen in the OTC gold market, for example, in London, which many of our customers trade and is, the most liquid in the world in terms of physical markets, customers say they've been short metal and the market's been in a contango. So you've been earning on your position. And what happened in the last 6 weeks was that the contango flipped into backwardation. There was a very large shortage of metal in London. And a lot of these customers who've been caught short suddenly having to pay to borrow metal overnight, which is a paradigm shift for these customers who've been used to earning dollars on their positions. So what can customers do? Well, there aren't that many choices when the market is moving against you into backwardation. You can tell it's only at the front end of the curve, so it's a short-term market scenario and a dislocation. But we don't know how long this is going to go on for because we don't know when the tariffs are going to be put on by the White House. So you only really have two choices. One is just to pay up every single day against the backwardation that's actually increasing, or you can close out your position, buy it back. And we saw a lot of customers starting to buy back in recent weeks, and that actually drove the spot price and COMEX gold futures price even higher. So that effectively starts to look like a short squeeze, and customers just had to close their positions because they couldn't afford to pay for those shorts any longer. Whether you like it or not, America First policy is here. The administration is making it clear that anyone obviously reshoring production or manufacturing of major enterprises in the US will not be subject to tariffs. I think those who have first mover advantage already have established supply chains or factories or already moving production to the US for the next 4 years, potentially 8 if it continues, will be reaping a lot of benefits from that. A lot of arbitrage opportunities are going to occur. It's obvious that China and America are going to be having a very in-depth I don't like the term trade war, but a divergence of opinions. And the tariffs, I think, on China, they may be threatened, but I was there in 2016 when the tariffs occurred, and the Chinese weren't really sure how it was going to happen. But there was Robert Lighthizer, who was the foreign official who was sent to Beijing to negotiate with the Chinese, and he basically said, if you don't agree, we're going to put 100% tariffs on Chinese goods to the US, 200% tariffs, and off they went. So eventually they made a trade deal, but it took almost 3 years. What happened with the Chinese was they actually devalued the renminbi in 2015. And we haven't even seen that happen too much with the renminbi yet on the Chinese side, because everyone's focused on what's happening with the COMEX in London, which is interesting. But China has a huge amount of capital that can flee out of the country. And we've seen almost $82 billion of capital leave China in December alone, if you analyze the trade statistics, which has obviously gone into Bitcoin and cryptocurrencies and other assets. But there's a huge amount more of capital that can leave if the trade discussions break down even further, which I think they will. And the renminbi has gone from 696, 697 to I think 7.3 odd. So it's almost a 5% devaluation we've seen in the last 6 weeks since the US election. And that has also increased volumes on Shanghai Futures Exchange of gold futures traded. And that's also compounding the issue of the gold price going up. And I think we're going to see this in multiple regions across the world as we go forward for the next 2 years. I think volatility is going to be here for some time. It is just the world we live in. Some people are finding it difficult to adapt to the new paradigm of extreme volatility across multiple asset classes. The news cycle is difficult to keep up with, and I think the trick is to keep your head screwed on, remain disciplined and calm, have your portfolio strategy, and stick to it. People should keep their stop orders at current support levels, keep their portfolios tidy, cut losses when you need to. And I think we're going to see more and more volatility over the coming 2 years. It's not necessarily a bad thing. And actually sometimes is a good thing, and it actually weeds out some of the weaker players in the market, and it creates an enormous amount of opportunity. And I think that's something to be embraced, not too worried about. Yeah, so we've seen a number of strategies from customers, from just basic spot purchases of gold to close out short positions. They've done that through StoneX. We have a global precious metals trading platform which the customers can execute almost any product globally in any location. We've had customers who are looking to sell forward, so lock in the price risk and not have any risk of the delta moving. If, say, for example, we have a lot of physical customers and we have this in PGMs, a customer might want to sell us rhodium, platinum, palladium, and that takes 3-6 months to refine at a smelter. They can sell us the material on day one. We can fix the price for the 3-month or 6-month hedge, whatever it is. And then once the material is processed by one of our partner refineries, or actually StoneX, we have our own refinery now, which we can do for silver, which we're very proud of. We can then enable the customer to buy back that hedge, and they can take delivery of the metal, or we can take delivery from them and buy it from them at different locations. So some customers recently have been coming on buying downside protection in options. A lot of customers looking to buy puts in gold, obviously at levels of 2650, 2500, 2450. But the premium is quite expensive on these options because everyone's looking for downside protection. Personally, I see where prices are headed. I see gold heading to $3,300, $3,500 an ounce. Silver is enormously undervalued. I think it will probably go to $35, $40 in short order. It's a different market though, because 75% of the world's silver comes from Mexico, so that can be delivered into vaults in the US relatively easily if there are not tariffs on Mexican silver. So there's a lot to think about there as well. And I also think copper, copper has been very interesting recently. The COMEX LME arbitrage, or the spread, has blown out, way bigger than what's really happened relatively in the gold market. That's gone to, almost $1,400 backwardation. And I think, or $1,200 backwardation. I think I'll go to $1,400 backwardation or $1,500 backwardation between the two, purely because expected tariffs on copper are likely to happen. Customers are looking at companies like StoneX, how they can hedge, and we offer those services. But we're advising customers, now's the time to manage your risk. You don't want to be caught on the back end of this when political sands are shifting so quickly, when you can plan your portfolio in advance. And things like copper, there are exchanges and products we offer whereby customers can do so, similar to gold and silver. Embrace change and expect the unexpected. I think we're going to see the most exciting commodities markets in the last 50 years. We probably haven't seen this since the 1970s. It is a time to be nimble, to be quick. It's great to work with companies like StoneX, where they have global trading platforms that can help you manage your risk across all regions and all products. But it is going to be, the people who can move fastest who reap the benefits the most.